Welcome to the deep dive. Today, we're getting into the weeds of State Street Corporation's second quarter 2025 results. We've got the earnings call transcript, the presentation, the addendum, the full package.
Yep.
And our mission, as always, is to cut through the noise, pull out the really important stuff, and basically give you a shortcut to understanding what's going on with this major financial player.
Exactly. And it's more than just the numbers, right? It's about figuring out the why. Why did they perform this way? What's their strategy in this, well, let's face it, pretty unpredictable market?
Definitely.
What I find fascinating is how these documents together really paint a picture. You see a huge institution navigating a really dynamic environment. It reveals their strategic thinking, not just spreadsheets.
Okay, so let's start with that big picture.
Yeah.
The overall takeaway from Q2 seems to be
Right.
resilience. Ron O'Hanley, the CEO, he kicked things off mentioning the terrible floods in Texas, which was important context.
Yeah, somber note to start.
Right. But then he pivoted pretty quickly to the quarter's performance. And he really stressed that, despite all the market volatility, geopolitics, economic uncertainty, the work State Street actually delivered strong results.
He used that phrase, didn't he? The powerful and diversified nature of our franchise.
He did. And the numbers seem to back that up. Let's look at the highlights, excluding those notable items we'll get to later.
Yeah.
Reported earnings per share, EPS, was up 18% year over year. That's $2.53.
Pretty solid jump.
Yeah. And total revenue, up 9% to $3.47 billion.
Yeah.
Fee revenue, which is a big chunk for them, up 12% to $2.74 billion.
That fee growth is significant. More predictable income stream.
Definitely. And they hit positive fee operating leverage, again, 526 basis points, and positive total operating leverage, too, 241 basis points. That's like the fourth and sixth quarter in a row for those, respectively.
Which points to real discipline on the expense side relative to revenue.
Exactly. Pre-tax margin, nearly 30%, ex notables, and return on tangible common equity, ROTCE, around 19%. So pretty strong headline figures.
And if you connect those dots, I mean, these aren't just lucky bounces, right? This feels like the result of, consistent, disciplined execution of their strategy over the last few years. It shows their investments are paying off.
Right. So let's dig into how they got there. The business momentum. Starting with investment services, that seems like a key engine here.
Absolutely.
They said it was a near-record quarter for sales. They pulled in over $1 trillion in new AUCA assets under custody and administration wins.
$1 trillion.
Yeah. And that translates to $145 million in new servicing fee revenue wins tied to that. They sound pretty confident about hitting their full-year target again, that $350 to $400 million range.
That suggests the pipeline is still strong.
Seems like it. And part of that story is State Street Alpha. 2 new Alpha mandates won in the quarter. 3 more clients went live, so that's, 28 live clients now?
Okay, so this Alpha platform keeps coming up. Why is it so critical for them? What's the big deal there?
Well, from what they're saying, it's really positioned as this central piece, this front-to-back platform that helps them deepen client relationships. The focus seems to be selling the back-office servicing.
Right, the core custody and admin.
Exactly, which drives those sticky recurring fees. And then, it opens the door for other things, deposits, FX trading, that kind of stuff. It's foundational.
So it's not just tech, it's about embedding themselves deeper into the client's workflow, making it harder to leave, basically, and creating more cross-selling opportunities.
That seems to be the idea. Okay, moving over to investment management. First off, they've rebranded. It's now State Street Investment Management.
Okay. A new coat of paint.
Yeah, they say it's about reflecting commitment to relationships, innovation, the future. It ties into their One State Street approach, trying to get different parts of the firm working together better for clients.
Makes sense. Leveraging the whole firm.
And get this, their assets under management, AUM, crossed $5 trillion for the first time. 5.1 trillion, actually. That's up 17% from last year.
$5 trillion is a huge number. Where are the inflows coming from?
Good question. Over $80 billion in net inflows for the quarter. And a record $68 billion of that was institutional net inflows. They highlighted strength in the U.S. defined contribution, the DC space.
Ah, the retirement plan market. That's a core strength for them.
Seems so. And here's something interesting on the retail side. Their U.S. low-cost ETF offering kept gaining market share. And their U.S. ETFs overall apparently led the industry in trading volume this quarter. Over $4.6 trillion traded. Number 1 in equity and commodities ETFs, top 3 in fixed income.
So they're competing effectively on cost and seeing massive liquidity in their products. That's quite a combination.
Yeah. And they also highlighted some strategic investments, things like a small case in India as wealth tech,
Hmm.
ethic for direct indexing,
Hmm.
and a stake in Investment, the big financial tech platform.
Okay, so those investments, they aren't just random bets, right? You see a pattern there.
Definitely feels like capability building. It's about adding new tools, especially around wealth management, personalization, accessing new markets like India, adapting to how wealth is changing.
Right. Small case for India access, ethic for the personalization trend, InvestNet for the advisor channel. It's plugging perceived gaps or um, augmenting their existing offerings for future growth, adapting to that democratization of wealth idea they mentioned.
Makes sense. Then there's State Street markets, their trading arm.
Mm.
They highlighted how they helped clients through the volatility, providing liquidity, which, also helps diversify their own revenue.
Volatility can be an opportunity for market makers.
Exactly. Their FX trading business had its best quarter since 2020, revenue up 27% year over year. And security finance, think securities lending, highest revenue since 2019, up 17%.
And what's really interesting there is how those long-term client relationships they build, combined with their market depth, really pay dividends when markets get choppy. Uncertainty for clients becomes a revenue stream for State Street because they can be that stable counterparty.
Good point. Okay, shifting gears slightly to operational efficiency and the balance sheet. They've wrung out over $1 billion in expense savings from productivity stuff over the last 3 years.
$1 billion is serious cost cutting.
And they expect that to hit over $1.5 billion by the end of next year, 2025.
How are they pulling that off? Is it just layoffs or something more structural?
They talk about the next generation of their operating model transformation. So, yes, there are job impacts, which we'll get to, but it's also heavily focused on technology AI, scaling platforms to drive efficiency long term.
Automating, standardizing, getting more efficient on the back end?
Right. And on the capital side, they're returning a good chunk to shareholders. Over $500 million just in Q2, $300 million in buybacks, $217 million in dividends. That's over $800 million so far this year.
Returning capital signals confidence.
And speaking of confidence, after doing well in the Fed's stress test, they announced plans to bump up the quarterly dividend by 11%, up to $0.84 a share. These board approval, of course.
Well, 11% hike is pretty significant.
Yeah. And they maintain solid capital ratios, CET1, at 10.7%, and the bank's liquidity coverage ratio, LCR, at 136%, well above requirements.
Healthy buffers.
Okay, so now, let's talk notable items. The things excluded from those adjusted numbers we started with. Mark Keating, the interim CFO, laid them out, totaled were $138 million pre-tax, about 36 cents per share impact.
Right, the adjustments. What were they?
The main one was a $100 million repositioning charge. This is tied to that operating model transformation we just mentioned, specifically severance for about 900 employees.
Okay, so that's where some of the job impact comes in. The savings will likely show up later.
Exactly. They expect the expense savings from this mostly in 2026. The other piece was about $40 million related to rescoping an alpha client contract.
Rescoping, what does that mean? Do they lose business?
Okay, let's unpack that a bit. It sounds like they adjusted the scope of a software, but part of an alpha contract, at a $24 million hit to revenue and an $18 million impact on expenses in the quarter. But, and this seems important, they stress the core relationship is still strong, and they highlighted alpha is designed to be interoperable. It can work even if clients use other front office systems. Crucially, they said this didn't affect the servicing fee revenue or the assets under custody related to that client.
So contained to a specific software element, not the underlying core servicing relationship. That's a key distinction.
Seems that way. All right, let's pivot to net interest income, NII. That was $729 million. Down slightly, 1% year over year, but actually up 2% from Q1.
Okay, so mixed signals there. What's driving that?
Mark Keating talked about the puts and takes, headwinds from lower short-term interest rates and shifts in deposit types.
Like more people moving cash to interest-bearing accounts.
Yeah, the deposit mix change, but those headwinds were partly offset by loan growth and their securities portfolio repricing at higher rates.
Okay, makes sense.
So the bottom line for NII, their outlook is still roughly flat compared to 2024's record level, but there's variability depending on rates and where deposits go. They did mention deposits spiked in April when markets went haywire, but then moderated in May and June. And most of that spike was in lower spread, interest-bearing deposits, not the really valuable non-interest-bearing kind.
Which brings up that point about State Street being asset sensitive, right?
Yeah.
How does that play into managing these NII dynamics?
Good question. Can you maybe elaborate on what asset sensitive means in this context?
Sure. So asset sensitive basically means the bank's assets, like its loans and securities, tend to reprice faster or more significantly than its liabilities, like deposits, when interest rates change. So typically, rising rates are a tailwind for an asset sensitive bank's NII, while falling rates are a headwind.
Okay.
Given the recent rate environment shifts, their ability to manage deposit costs and mix becomes really crucial. And that ability to generate deposits from winning core custody and servicing business is key because that business naturally brings in deposits, often less price-sensitive ones.
Got it. And you mentioned regulatory constraints earlier. What's the main one for them?
Their binding constraint, according to the call, is Tier 1 leverage. That's the capital ratio that effectively limits their balance sheet growth and capital return the most under current rules.
Right.
And interestingly, O'Hanley mentioned regulators taking a sensible look at some post-crisis rules. It hints at a potentially slightly less stringent environment for big banks, the GSIBs, down the road, though he cautioned changes probably won't be immediate.
Okay, interesting nuance there. So, looking ahead, what's the overall outlook? They seem more optimistic.
Yeah, they bumped up their guidance. Total fee revenue growth for the full year now expected in the 5% to 7% range. That's up from 3% to 5% before.
That's a decent improvement. What about expenses?
Expenses also guided slightly higher 3% to 4% growth now versus 2% to 3% previously. They cited higher revenue-related costs and some currency headwinds.
But the key thing.
The key thing is they still expect to generate both positive fee operating leverage and positive total operating leverage for the full year, meaning revenues are expected to grow faster than expenses overall.
That's the goal, right? Disciplined growth. What about big strategic moves like mergers and acquisitions? Any change in thinking there?
Not really, according to O'Hanley. The philosophy seems consistent. M&A can complement organic growth, but the bar is high. It has to make clear strategic sense.
So those recent smaller deals, small case Ethic InvestNet, fit that mold.
Exactly. He framed those as capability building,
Mhm.
adding specific functions or market access, not just buying scale for scale's sake. So sounds like they feel pretty good about their current setup, but are always looking, selectively.
Okay. And finally, innovation.
The idea seems to be to develop something, a kind of financial platform or operating system that could be leveraged elsewhere. Other universities, maybe other large organizations. It's a bet on building scalable tech for wealth access.
A potentially very large-scale bet.
Yeah.
Anything else on the innovation front?
The other area was tokenization. Now, this is where it gets really forward-looking.
Right. Tokenizing assets on the blockchain.
Exactly. They acknowledged it's been maybe slower to take off than some expected, but with regulatory frameworks starting to emerge globally, they think the pace will pick up.
What kind of opportunities do they see?
It's broad. Tokenizing deposits or money market funds to use as collateral, making traditional illiquid things like real estate or private assets more easily tradable. The big question mark, though, is how regulators will ultimately treat it all, especially its impact on core bank deposits and, monetary policy.
So, still early days, but they want to be involved.
Definitely. They intend to be a player, both as a servicer for tokenized assets and potentially as a bank dealing with tokenized liabilities like deposits. It's about being positioned for a potential shift in financial plumbing.
Okay, wow. We've covered a lot of ground there. From these strong Q2 results
Yeah.
driven by investment services, investment management, the markets division,
Right. Underpinned by that strategic execution.
to the disciplined cost management, the capital returns, and these, well, pretty interesting forward-looking bets on wealth tech and tokenization.
And if you step back and look at the bigger picture, it really underscores how even for these massive established financial institutions, things like agility, investing in tech, focusing relentlessly on the client, they're just becoming absolutely critical.
Non-negotiable, really.
Pretty much. And State Street's ability to keep delivering that positive operating leverage, even while navigating all this market chop and investing for the future, it does point to a pretty solid strategic foundation they've built.
So, as you, the listener, digest all this, maybe chew on this question, how do you see these big trends, AI, tokenization, the changing nature of wealth, reshaping banking and investment services over the next, say, 5 or 10 years? And what role will giants like State Street play? Will they lead the change or mostly adapt? What really stands out to you from today's dive?
Good question to ponder.
All right, that's all the time we have for this deep dive. Thanks for joining us, and we look forward to our next exploration.